Hello and welcome to Traders Corner. I'm Bronwyn Seaborn, and joining me at the desk as usual is Garth McKenzie, editor and founder of Traders Corner. Garth, thanks so much for your time today.
Thanks. Hi, Bronwyn.
So we had the S&P 500 rally a little bit yesterday, obviously ahead of the midterm elections, which is really taking up a lot of focus and creating a bit of choppy trade. So what are we seeing on the S&P 500 today?
Yes, it's certainly interesting. This midterm election is a big deal, and I think it's going to be interesting to see the results and what that dishes up for the markets. I've got a weekly chart of the S&P 500 up here, and I know I showed this last week. We always show it, but the weekly chart specifically is what I've been looking at the last two shows. And the reason why is because I want to show the significance of the upward trend that had been intact since early 2016. And you can see how that joined all the low points throughout 2016 and again throughout 2018 and the first half of this year. Now, the break below that upward trend is quite significant from a technical perspective. And last week on the show, I pointed out the fact that there was this lateral zone of support at around about 2600 and that we would be watching that. And we will revisit this later in the show because we've actually got a trade on the S&P 500 for this week, which is something we flagged last week. But just in terms of the weekly chart, it is significant that that upward trend has been broken. We've held the lateral support to 2600 now, and we are bouncing. But I think it's notable that that upward trend, that linear trading action that we've seen over the last number of years has actually been broken to the downside. And my suspicion is that this volatility that we've seen this year is the start of more volatility to come. And I do think that next year could dish up for more of this kind of volatility. And I just think it's a warning shot in terms of the fact that this bull market is very aged and there are risks mounting on the horizon. And the equity market is starting to reflect those risks, I believe. So that's the weekly chart. If we then fast forward to look at the daily chart here, this is a year-to-date graph of the S&P 500. So you can see all the volatility that we saw in the first quarter of this year when we saw that big drop-off in February and subsequent rallies and drops off again. A very volatile time in the first quarter of this year, actually. Then it got calmer during the second and third quarter of the year, and then obviously you can see this recent sell-off that we've seen during the month of October here, a very vicious sell-off where the S&P 500 has fallen over 300 points from its peak to trough during the month of October. So it really was quite an ugly month. We have managed to bounce off that lateral support zone that I've identified there at 2600. And it does seem as if the market is now putting in a little bit of a recovery at this stage. But I expect that we're going to still see volatile trade for the next while, and that we're going to probably see quite a lot of choppy action in the months ahead. I think 2,800 is likely to be quite a big area of resistance. If you look at that little black box that I've put into the graph over there now, you can see that is where the 50% and 61% retracements of this recent drop come into play on the S&P 500. So I would think up at around 2,800 is where this market runs into a bit of resistance, and then we could probably see quite a lot of choppy action thereafter, maybe very similar to like what we saw in March and April of this year after that big sell-off in January.
Okay, so we'll take a look at how we're putting all of that into play into our trade of the week in just a little bit. But let's come back home in the meantime, because we've actually gained quite nicely over the past week.
Yes, the top 40 future is what we're looking at here. And you're right, we've actually picked up very nicely. The market traded down below 45,000 last week. In fact, it got not far away from 44,000 actually. And we now have bounced all the way up to 49,000. So we've had pretty much a 5,000 point bounce in just over a week. So for those that like volatility, it certainly has been rearing its head lately, and you can see it quite clearly on this graph. What's notable here is this 49,500 resistance, and the break below there was a very bearish break, which resulted in quite a violent sell-off, as we can see in October. We've now seen a nice rebound over the last week, but again, notice how this 49,500 area appears to be acting as resistance here. And I think that area is likely to be quite sticky in the days and weeks ahead, and it won't surprise me too much if we do actually come back and start to fill some of these lower gaps on the graph that have been created on the way up here. So again, more choppy action expected, I think, with a lot of resistance up there at 49,500.
Okay, so in that context, let's revisit a trade from a few weeks ago. That's that pair trade that we had on Pioneer and Zeder. Remind us again how that trade worked, because it was a little bit different to what we usually do.
Yes, it is a bit different. So a pairs trade is where you take two similar stocks that have some sort of relation to each other, typically. In this case, Pioneer Foods and Zeder do have a relationship because Zeder is an investment holding company that owns a very large stake in Pioneer Foods. And as a consequence of that cross-shareholding, you'll notice that the two share prices do typically track each other quite closely, as you would expect of a relationship like that. Now, what I've got here is a normalized graph just showing the trading action of Pioneer Foods and Zeder over the course of this year for the year to date. And you can see there's very clearly a correlation between the two share prices over there. But there are times where the gap opens up. And that is usually where you have an opportunity to try and exploit the opening up of that gap and then a narrowing of the gap. So we saw it in May and June of this year where the gap opened up a little bit. And then again recently in October, we saw the gap opening up quite significantly because Pioneer Foods dropped very sharply following some disappointing results. And Zeder's share price didn't drop. It actually stayed fairly well propped up. And hence you see that big gap opening. And by spotting this, typically what you would expect is a normalization over time where the two share prices eventually revert back towards each other. In this case, it would mean going long of Pioneer Foods and short of Zeder, which is exactly what we did in this case here. Now, it has worked out quite well. Looking at it a different way, this is now a chart, a relative comparative graph of Pioneer Foods share price divided by Zeder. So what you do is you take all the historical daily closing prices of Pioneer Foods and you divide those values by the corresponding historical share price closes of Zeder. And then you plot those results onto a graph. And what you'll notice by looking at this goes back over a year now. If you just draw sort of a horizontal line more or less through the middle of all that noisy trading action, you'll notice that Pioneer Foods share prices typically traded around about 20 times higher the value of Zeder's on average over the last year. Of course, we had a massive dislocation here in September and October this year, and that came about after Zeder put out Pioneer Foods rather put out some disappointing results, and we saw that gap opening up between the two share prices. Now, when you get that sort of situation, you would expect some sort of a normalization of the share price ratio between the two companies. And what it meant is that in terms of a pairs trade, what we did here was we went long of Pioneer Foods, expecting that share price to mean revert back towards the Zeder share price, and then short of Zeder. So effectively what it means is you've got a market neutral trade because you're long of one stock and short of another, and they're closely related to one another. All you are really doing is betting that the one stock is going to outperform the other. That's essentially all it means. We went long of Pioneer Foods at 74 Rand 74 cents. We went short of Zeder at 4 Rand 56. That meant that the ratio between these two share prices was 16.39 when we did that. The value that I did here was 100,000 Rand on either side. So short 100,000 Rand worth of Zeder, long 100,000 Rands worth of Pioneer Foods, and we look for that gap to close. Now, what you can see is that the relative graph of the two companies has begun to move in the right direction for us. It has begun to move higher. I've decided to actually bank profits on this trade now. My sense is that there could still be more left in this trade where you might find that that relative graph still moves further to the upside from here. But we have done pretty well. In fact, this is going to end up being one of our better trades of the year to date. So I'm quite happy to take the profit at this late stage of the year, chalk it up, and put it onto the list of winners for 2018. So what we've done is we've sold out of the Pioneer Foods at 86 Rand and 8 cents, and we've bought back the Zeder short at 4 Rand and 75 cents. That means that the ratio between the two share prices now, when we've closed it, is 18.12. And what that's resulted for us is a profit of almost 9,600 Rand for the portfolio.
It's not bad at all.
Not bad at all. In fact, in terms of percentage gain for our portfolio, it gives us a 6% gain on our capital that we started the year with. So that's good going for a single trade to make that much return. I'm very pleased with that.
Absolutely. And like you say, a nice boost for our local portfolio. And we're hoping that this week we can give our international portfolio a little bit of a boost. So let's go back to the S&P 500 because that's what you're looking at to help our offshore portfolio.
Yes, I flagged this last week on the show, and I said, watch this area around 2,600, maybe 2,580. That is a big lateral support zone on the S&P 500. And I said that I would either look to go long, either via some sort of an exotic option structure, or otherwise just go naked long. Now, I decided, just for simplicity for the show, we're going to stick to vanilla stuff here. The options do get very complicated. So I've gone purely long on the S&P 500. Very simple trade. We went long at a level of 2,655. That was after it bounced up off that 2,600 level quite convincingly. And I put a stop loss below 25.90, which meant it would need to go below last week's low effectively to trigger that stop loss. And I'm going to look for a move up to about 2,800 here, as I mentioned earlier on in the show. So if we look at the mechanics of this, how do we execute this trade? I'm long from 2,655. My stop loss is 2,590. That means, therefore, that my risk is 65 index points on the S&P 500. Now, I'm going to risk 1.5% of our offshore capital. We've got about $16,000 at our disposal here. So 1.5% of that is $240. So essentially, I'm willing to lose $240 if I'm wrong on this trade. Taking that capital risk of $240 and then dividing it by our risk of 65 index points leaves me with a figure of $3.69 per point. Now, I can't do the decimal. I've got to round it off, either $1 to $3 or $4. So I've rounded it down to be conservative, and we've gone long $3 per point on the S&P 500 here. My target, as I said, is 2,800, and the risk to reward ratio on this trade, if it gets to that target, is 1 to 2.2. So it's a reasonable risk to reward ratio here.
Okay, so then let's look at the portfolios, because if I understood you correctly, we're kind of saying on the South African local front, we're happy with it how it is, we're not going to touch it again, so let's have a look.
Yeah, well, look, we may still touch it. We've got about a month left of the show for this year, so I'll continue to look for opportunities, but at this stage, we've done well in a very tough year, and I certainly don't want to mess it up in the 11th hour, as it were. We're up 28% for the year to date on the South African portfolio. There you can see the pairs trade in green, highlighted there between Pioneer Foods and Zeder. We came out with a 9,000 Rand profit there. And then on our offshore portfolio, we now have done something, finally. I know it's been a bit dull of late. But that portfolio is up 10.5% for the year to date. And as I said, we long the S&P 500 from 2,655, and we'll look to bank profits on that into any further strength towards 2,800.
So maybe with the end of the year coming up, you want to relook your New Year's resolutions, and maybe upping your trading game is one of them. And then you're saying that the 17th of November is a key date to kickstart that resolution because you have a course coming up.
Yes, my final high probability trading course for the year will be on the 17th of November. It's Saturday, 2 weeks' time. It's a full day course covering all the basic principles that I look at in terms of how to identify high probability trades, how to apply the correct risk management and money management philosophies, how to develop a trading plan, all that sort of thing. The price is 1,990 Rand per person, and that will include a 1-month trial subscription to Traders Corner. So anyone who's interested in attending that, please send me an email, garth@traderscorner.co.za, and I'll send you all the details.
And of course, it's always a good idea to keep up to date with all the trading that's happening out there. And of course, expert analysis as well. And our viewers can subscribe to your weekly newsletter for that.
Yes, if you go to traderscorner.co.za, in the middle of the page, you'll see a link to a free weekly email. We will send you an email every Tuesday at lunchtime detailing what's coming up on the show for that week if you subscribe to that. And it's absolutely free, as you mentioned.
Garth, thanks so much for your time today.
Thank you.
Garth McKenzie is founder and editor of Traders Corner.